from where they naturally would have came over the course of the year. All right, well, let's move on to Brennan's honest opinion on Jessica Alba. No, wait, on the Honest Company. Why do we keep revisiting this company, Brennan?
Just because of Jessica Alba.
Yeah, I knew it. We knew it.
Yeah. And again, I apologize. Hopefully the construction outside isn't loud. So let's
honestly, we don't hear it.
Well, that's good. That's good. Honestly.
Just terrible.
Honestly, that's great. So yes, the Honest Company, HNST on the NASDAQ, currently trading at a price of about $5.42, market cap of $607 million. And they are a personal care company dedicated to creating clean and sustainably designed products. Its products include baby clothing, diapers, wipes, nursery products, skincare, and makeup. And like Ryan said, the company was co-founded by actress Jessica Alba and IPO'd at $16 per share in 2021, raising over $400 million. And I included the 2023 breakdown of revenue by products to give listeners a general sense of the breakdown, as unfortunately in their May 2025 presentation, they do not include an updated pie chart. So they aren't being so honest there. So since its IPO in 2021, the stock has really been in free fall as the company has been unable to generate any profitability or sustainable cash flow. But when I covered the stock last, it was up significantly, driven by the company's strong Q3 2024 results. And I covered it last in November of 2024, while it traded at about $7.30. However, the stock price has tapered off back below $6 per share. So let's get an update on the business overall. When we looked at the long-term financials last time, since 2019, we could see that revenue was growing with a compound annual growth rate of about 10%. And while operating and net income was still negative, it was trending in the right direction, especially adjusted EBITDA had become positive. Now, looking at the recent quarter of Q1 2025, revenue increased 13% to $97 million and was driven by strength in baby products and its wipe portfolio. Gross margin increased 170 basis points to 38.7%, driven by product and supply chain cost savings. Adjusted EBITDA was positive $7 million compared to $3 million for the same period last year. And this represents the company's sixth consecutive quarter of positive adjusted EBITDA. If you're looking up at the screen right now, this is just including Q4 of 2024. It doesn't show the Q1 of 2025. Now, net income was a gain of $3.2 million compared to a loss of $1.4 million for the same period last year. So, like I concluded last time, it appears the profitability is continuing to trend in the right direction, which is good to see. Now, the company was able to achieve its fiscal year 2024 guidance with revenue growing in the high single-digit range, coming in at 10% for the year, and adjusted EBITDA exceeded the high end of management's $20 to $22 million target range, coming in at $26 million in adjusted EBITDA. Now, looking towards fiscal year 2025, the company is only guiding toward mid-single-digit revenue growth, and adjusted EBITDA is expected to be up about 10%. So growth in revenue is expected to moderate to some degree compared to the growth in 2024. And in November, when I covered the stock, based off of its 2024 forward guidance, it was trading at about 31 times forward enterprise value to EBITDA. Again, the stock, I think, was about $7.30 then. But now, using its 2025 guidance, it trades closer to about 19 times. And on a price to cash flow basis over the 12 trailing month period, cash flow has gone negative. So we unfortunately cannot get a gauge on the valuation when it comes to cash flow. And the same can be said about the trailing price to earnings multiple, as net income over the last 12 trailing months is negative. Now, looking at the balance sheet, it remains quite healthy with cash of $72.8 million, no debt, it just has leases, and a net cash position of $61.8 million. But we can see that the company's share count continues to creep up. As last time I covered the stock, it was at about 100 million shares outstanding, but is now up to 110 million shares, or about 115 million shares fully diluted. The company continues to be in its strengthen phase, but management indicates there is scalable growth opportunities by increasing its distribution points from 45,000 doors selling at the end of 2024, with 65,000 remaining doors available for the company to tap into. They also believe that they have an opportunity for larger presence on the shelf, with competitors possessing over triple the average products on shelf per store compared to Honest. So to conclude here, the Honest Company is in a highly competitive markets with over 60% of its revenue coming from diapers and wipes. But like I said last time, these are more consumer staples, which are a bit more defensive. The company has a good track record of producing high single-digit revenue growth, growing with a compound annual growth rate of 10% from 2019 to 2024. And the business has increased margins now with 6 consecutive quarters of positive adjusted EBITDA, but revenue growth is moderating in 2025. The balance sheet remains healthy with net cash per share of about 56 cents per share. And the stock's valuation is better than we covered it in November of 2024, down to 19 times forward EBITDA from 30 times forward EBITDA. But revenue growth is expected in the mid-single digit range, with EBITDA growth expected to be around 10% at the midpoint. So right now, I think that the business is trading closer to fair value, or at least isn't screaming value at this point. If revenue was expected to grow in the mid-teen percentage range, along with EBITDA, it may be 20%, something along those lines, I think that it would then be more appealing. But overall, I don't think it's a bad business, and it does check off a lot of boxes for our investment criteria. Cash-rich balance sheet, getting into profitability, a runway of growth. But I continue to think the business is a little early for us, as we would like to see, continued ability to massage those margins higher and generate more meaningful profitability and get into, sustainable cash flow or positive cash flow. Keep in mind as well, they only did adjusted EBITDA margin of 7% in fiscal year 2024, and the business is expected to be at approximately 7% adjusted EBITDA margin at the midpoint in fiscal year 2025 as well. So keeping that in mind, it's not a high margin business by any means. So I can understand why the stock has pulled back since we last covered it, as it was projecting better growth in 2024, along with more of an inflection in margins due to its cost savings initiatives. But right now, I think it's just closer to fair value, and we will continue to monitor the business. Any comments, guys? Absolutely.
No, I was waiting for Ryan to unmute.
Honestly, not a ton of comments on that one.
Honestly, that's fair.
Yeah, no, it's. I mean, it's a good summary of the business, and and we know why we reviewed it, right? So.
I actually do got something. Don't worry.
Yeah, go on.
Okay, good.
So just on them being impacted by tariffs, like we have to talk about everything right now. Their diapers are USMCA compliant, and they're from Mexico, so they're fine there. But then their wipes on the other side are from China, so they're impacted there. So right now, doing a bit better than what they were a couple of weeks ago with the rate dropping, but obviously that changes as we've repeated. I don't know how many times at this point. So
honestly, I don't know.
Honestly, we don't know how many times we've said that, or how many times we've said honestly. Mm-hmm. But that will further impact their margins, and that's what Brendan's really focused on with this company. Is the margins are not that big; they're small. Yeah. It's pretty interchangeable. If diapers do go up in price, you're probably going to just switch out for another brand if you need to. Mm-hmm. And it's really hard to get those big margins, which is what my concern would be over the really long term for the company is, can they actually expand their margins enough to support a 19, 20 times EV EBITDA like they are now? Yeah. In which I don't think it really deserves that multiple at this time with the margins it has, no. I would say.
No, honestly, yeah. I don't think so long term.
And honestly, I thought that was a great comment, Brett. And honestly, I think we should move on to Brett's segment.
Let's put that one to bed, thankfully. All right, let's go